It's a Monday morning and a new week for the financial and capital markets. You're on to the market review where we bring you updates on the financial and capital market as it relates to economy. Let us give you a lineup of what we will discuss today, July 27th, 2020. We'll give you a regular review of market performance, AfriInvest financial market analysis, outcome from GlaxoSmithKline 2020 annual general meeting. FBN Holdings advises retail investors to go for companies with strong fundamentals. At the global level, US Fed meeting and US stocks performance. And lastly, US-China trade tension and global investors taking flights for safety. We begin with the review of market activities for last week, and from the equities market, investors gained 73.7 billion naira week on week as the NSE inched up by 0.58% to close the week positive. That was an interesting NSE analysis. For the NSE OTC market, the market capitalization increased by 0.01% week on week to close at 518.99 billion naira. That was showing a positive for both the NSE and NSD markets. Very interesting. Now let's get some further insight from Codrus Capital on the breakdown of market activities, particularly equities, fixed income money markets, and what we should expect in this week. For the equities markets, sentiments remained weak in the domestic market amidst rising COVID-19 cases in the country, as well as persisting foreign exchange illiquidity. However, a one-off gain from Thursday last week, driven by a surge in Dangote cement, that's plus 6.5%, led the domestic bourse to its largest weekly gain in 7 weeks. That was thanks to Dangote cement. Thus, the all-share index advanced by 0.6% week on week to 24,427.73 basis points, and was also supported by gains in MTN Nigeria, which had plus 1.7%, and Stanbic IBTC, which had plus 3.5% gains. Notably, the month-to-date and year-to-date losses moderated to minus 0.2% and minus 9.0% respectively. Analyzing by sectors, the oil and gas had minus 4.7% index, which led the losses, followed by insurance minus 0.8%, banking minus 0.6%, and consumer goods minus 0.4% in terms of indices. The industrial goods had plus 0.6% index, which was the sole gainer for the week. Interesting. Codrus Capital Research, from its view, continues to favor cautious trading owing to the fact that the gains recorded last week were not broad-based. They reiterate that risks remain on the horizon due to a combination of the increasing number of COVID-19 cases in Nigeria and weak economic conditions. Thus, Codrus Capital continues to advise investors to seek trading opportunities in only fundamentally justified stocks. That's a word to investors. Let's go on to the money markets. The overnight rates, according to Codrus Capital, plunged 19.5 basis points to 2.2% as inflows from the Federal Allocation Account, FAC, disbursement to state and local governments, which was 430.3 billion naira, then the federal government bond coupon payments of 94.42 billion naira, and the OMO maturities of 25.36 billion naira boosted system liquidity and outweighed outflows for federal government of Nigeria bond auction debits, which totaled 178.52 billion naira. In terms of what to look out for in the week, Codrus expects an expansion in the overnight rates and also expects inflows into the federal government of Nigeria bond coupon payments of about 49.61 billion naira. That particularly will not be sufficient to support liquidity, especially if the conduct on the OMO auction continues. In terms of Treasury bills, trading activities picked up in the Treasury bills secondary market on the back of healthy liquidity in the system. Thus, the average yield across all instruments contracted by 68 basis points to 4%. The overall market was majorly impacted by the OMO segment, which had minus 96 basis points to 4.6%, as reduced funding pressures for local banks buoyed participation amid weak participation from foreign portfolio investors. At the NTB segment, that's the National Treasury Bills, retail demand continued to support activities despite the abysmal yield in the space. This week, Codros expects strain in system liquidity, and this should impede the demand for instruments in the space. In the Treasury Bills segment, it expects market participants to switch focus to primary markets where the Central Bank of Nigeria will be rolling over maturity bills worth 256.95 billion naira. Let's go into the bonds markets. Trading in Treasury Bonds secondary market was bullish for last week as investors reinvested maturities and coupon payments and looked to cover lost bids at the primary market auction. Thus, the average yields contracted by 50 basis points to 7.3%. At the primary market auction, the DMO, that's the Debt Management Office, offered instruments worth 130 billion naira to investors through 3 openings, 12.5% rather for the January 2026 bid to offer, which was 2.9 times stop rate at 6%, 12.5% March 2025 bid to offer, which was 1.7 times stop rate at 9.5%, and 12.98% for March 2050 bid to offer 5.9 times stop rate of 9.95%, and a new issue of 9.8% for March 2050 bid to offer 3.7 times stop rate of 9.8%, which has the second lowest coupon rates in the Treasury Bonds market. Despite a total subscription of 470.13 billion naira, the Debt Management Office eventually allotted instruments worth 177 billion naira, resulting in a bid cover ratio of 2.7 times. This week, Codros expects investors in the Treasury Bonds market to continue to cherry pick due to the relatively attractive yields in the space. Let's go on to the foreign exchange market. The Central Bank of Nigeria's foreign reserves sustain its descent as FX outflows continue to outpace inflows, thus dipping by $86.69 million week on week to $36 billion in terms of the foreign reserve. Nonetheless, the Naira weakened against the US dollar by minus 0.3% week on week to 389 Naira to a dollar at the import and export window, and by 0.4% to 472 Naira to a dollar at the power market. In the forwards market, the Naira weakened against the dollar across the 1 month, that's minus 0.3% to 391 Naira 38 kobo to a dollar. In terms of its 3 months, it had minus 0.4% to 295 Naira to a dollar. In terms of the 6 months, it had minus 0.6% to 400 Naira to a dollar, and for 1 year tenure, it had 1.1% to 418 Naira to a dollar in terms of the forward contracts. For this week, Codros says in terms of the foreign exchange, despite CBN's stronger commitments towards exchange rate unification, it sees legroom for the currency to depreciate further, at least towards its real derived value. The prognosis is hinged on the widening current account position, currency mispricing, which could induce speculative attacks on the Naira, and the resumption of FX sales to the BDC segments of the market, which should place an additional layer of pressures on the reserves as the Central Bank of Nigeria funds the backlog of unmet FX demand. Well, let's move on to AfriInvest again. We'll give you analysis on the Nigerian first half of the year performance and second half of the year 2020 outlook for the financial markets. First, looking at the equities market, what he had to say, and tagging it COVID-19 throttles positive return. The equities market, according to AfriInvest, kicked off the year amid stronger optimism, propelled in part by the unattractive fixed income yield environment and the hunt for high dividend yielding stocks by investors. However, the outbreak of COVID-19 pandemic and economic fallout swiftly put an end to the early optimism, with the resulting fear and uncertainty dictating market sentiment for the rest of the first half. As the pandemic continued to spread, with Nigeria recording its first case, stocks lost 9.1% and 18.8% in February and March due to lockdown and elevated external risk. In early April 2020, sentiment worsened on the back of weaker oil prices, fueling exits that dragged the year-to-date return to a low of minus 23%. However, interest from local bargain hunters mostly drove the market performance in April at plus 8.1% and May at plus 9.8% into positive territory. The benchmark index settled at a year-to-date return of minus 8.8% in the first half of 2020. Events of the first half of the year caution against an overly optimistic outlook for second half. According to AfriInvest, it envisages that the recovery pattern in first half of the year 2020 will be sustained due to an improvement in risk appetite, mostly from the locals, and an improvement in external condition. That said, AfriInvest notes that the downside risk to its expectation includes tightening of the partial economic reopening due to the new wave of COVID-19 spread, lower oil prices, the MSCI's classification of the Nigerian market as a standalone, continued FX illiquidity, and weaker than anticipated economic and earnings growth. Based on the listed drivers, AfriInvest foresees three possible scenarios in second half of the year 2020. The pessimistic case of about minus 11.8%, the base case of minus 2.8%, and optimistic case of minus 6.2% for the equities market. If you're an investor, you must have taken note now. Let's go on to the fixed income market. What does AfriInvest have to say in terms of review? In our outlook for the full year 2020, AfriInvest had envisaged that short-term yields would be driven by monetary policy, while movement in long-term yields was expected to be influenced by the activities of long-term investors. AfriInvest also expected attractive carry trade to continue, especially in the emerging markets, with improving macroeconomic outlook due to higher yields compared with yields in advanced economies. In 2020, policy rate cuts, along with other measures, became the new norm for most central banks as the novel coronavirus rattled major markets and economies. The US Fed cut interest rates by 150 basis points to a range of 0% to 0.25% and also commenced asset purchases, buying back of about $3 trillion worth of instruments amid other fiscal policy measures to lessen the economic impact of the pandemic. These developments will ordinarily imply more funds to the emerging markets as investors hunt for higher yields, but the pandemic and its related uncertainties have necessitated flights to safety, with investors exiting emerging market assets. That includes countries like Nigeria. Contrary to its expectations of a sustained bullish performance in the sub-Saharan Africa region and sovereign and corporate Eurobonds, both the sovereign and corporate Eurobond instruments under the AfriInvest coverage reported sell-offs as yields rose 186 basis points and 120 basis points respectively. To fund the revised budget of Nigeria deficit, which is about 4.6 trillion naira, the federal government is sourcing about 2.1 trillion naira, equivalent of $5.9 billion from multilateral lenders, with an addition of $2.2 trillion expected to be borrowed in domestic markets. While it is cheaper for the federal government to borrow locally at current yields, AfriInvest does not rule out the possibility of ways and means funding by the Central Bank of Nigeria, especially when fiscal deficit overshoots targets. Already, 510.9 billion naira has been borrowed in the markets in the first half of the year, with 1.7 trillion naira outstanding in second half of the year 2020, which may be raised in the fixed income market or borrowed from the Central Bank of Nigeria through ways and means. On demand side, AfriInvest expects inflows of maturities worth 8.1 trillion naira from Treasury Bills. OMO and bonds in second half of the year 2020 will also follow suit. Although this is lower compared with the maturities of 11.3 trillion naira in the first half of the year, it remains sufficient to push yields lower. AfriInvest believes that if the Central Bank of Nigeria decides to tighten liquidity significantly by issuing OMO bills to prevent sharp portfolio outflows as FX demand backlogs are met, there could be significant improvement in yields. In terms of investment strategy for 2020, AfriInvest says at the start of the year, they had expected accommodative monetary policy in advanced economies to drive fund flows to emerging markets assets in search of yields. However, with the outbreak of COVID-19, investors initially panicked and retrieved funds from the emerging markets to safety, resulting in massive rise in yields. On the back of gradual resumption of economic activities, AfriInvest has seen investors return to the emerging markets assets as yields remain attractive. A review of performance of the portfolios AfriInvest recommends for 2020 revealed positive performance from both the modified duration portfolio and the passive bond portfolio. AfriInvest modified duration portfolio performed best in the first half of the year with an average return of 18.9%, outperforming the benchmark S&P FMDQ Sovereign Bond Index with a 17% return in the first half of the year. Similarly, its passive bond portfolio comprising domestic corporate bonds reported an impressive 14.9% return. The effect of the pandemic was mostly felt in its smart Euro bond portfolio, which returned minus 3.5%, with all instruments recording losses during this period. For the second half of the year 2020, AfriInvest maintains its recommendation for the smart Euro bond portfolio due to improving prospects for commodity prices. It also believes that the passive bond portfolio remains attractive for investors buying to hold due to its high yield and liquidity. For the modified duration bonds, AfriInvest has made adjustment to the selection to balance the interest rate risk in the portfolio. That's from the stable of AfriInvest Research, and that was published on ProShare, Nigeria's leading financial information hub. You can log on to our website, www.proshareng.com, to read more and get more insights on that report. GlaxoSmithKline PLC declared a profit after tax to the tune of 970 million naira. Yes, and shareholders will receive 55 kobo per share as dividend. That's a total of 657.7 million naira for the year ended December 2019. The company's annual turnover increased from 18.41 billion naira in 2018 to 20.76 billion naira in 2019, representing a 13% growth, while its profit after tax rose from 617.62 million naira to 917.10 million naira. Mr. Edmond Onuzo, Chairman Board of Directors, said at the company's 49th annual general meeting, which held recently, that despite 2019 being a challenging year for manufacturers in the country, the company was able to achieve a sustainable performance on all its healthcare portfolio. According to him, GSK delivered a good performance in 2019 with growth in sales, earnings, and strong cash generation. We also made excellent progress in our three long-term priorities: innovation, performance, and trust, strengthening our consumer healthcare portfolio, improving operational execution, and reshaping the company. He further disclosed that the task before the company in the new financial year is to drive its strategic objectives that will not only keep the business afloat, but make its portfolio more efficient and profitable. Mr. Nuzo affirmed that achieving these objectives may be challenging, most especially with the current realities of COVID-19, which has resulted in major shifts in the stock market and a downturn in Nigeria's economy. Speaking further, he said this year started as a great challenge with the novel COVID-19 pandemic. However, we remain resilient as we innovate and adapt in this unprecedented time. We demonstrate this confidence with the right strategy to deliver consistent and sustained value for our customers and shareholders. We are optimistic that our focus on innovation will enable us to capitalize on opportunities that will propel the organization to drive long-term value for investors. Mr. Kunle Oyelana, Managing Director and CEO of GlaxoSmithKline, said Consumer Nigeria PLC expressed his confidence in the economic outlook for 2020 while expressing appreciation for the immense support from all stakeholders. Hear him. He says, "We are pleased with the result for 2019 despite the decline in our financial statement and annual report. We were able to grow significantly, both the top line by about 13% and, of course, the profit by higher than 40%. This is a testament of the incredible work of all various stakeholders, both internal and external. For 2020, while the subdued outlook for the economy based on the current pandemic and the impact of that on the consumer demand and affordability of the consumer, we expect to still stay very focused on our strategic objectives for the year 2020. And we are confident that with the support of everybody working together, we will achieve the objectives we have set for ourselves. That's from GlaxoSmithKline, talking about innovation, talking about performance, and talking about trust, which is very key for its operations. Let's go on to ABN Holdings, who has stressed the need for retail investors to invest in companies with strong fundamentals, sustainable growth, and profitability to ensure enhanced returns on investments. Mr. Tolu Oluwole, the ABN Holdings Head of Investor Relations, said this last week at the Capital Market Correspondents Association of Nigeria Virtual Forum held to discuss around investment and activities of retail investors. Mr. Oluwole urged retail investors to go beyond speculation and invest in stocks with strong fundamentals, sound management, and potentials for growth. He said COVID-19 pandemic and the downturn in stock market provided an opportunity for investors. According to him, understanding to invest in good company, such as the investment of financial market companies, is key at this time for investors. Mr. Oluwole noted that it was an opportunity in any market downturn, urging investors to key into the present opportunity. Institutional investors' participation in the market, he stated. On the exit of foreign investors, Mr. Oluwole said they would soon find their way back to the market in a matter of time with strong business fundamentals. The presentation on the financial media and engagement with retail investors, speaking further, he said there were a number of different investors with varied levels of interest in a company's investment story. He noted that while majority of the audience have broad, similar requirements, there are subtle differences, and it is critically important to ensure consistency in the message to avoid misinterpretation. He described retail investors as non-professional market participants who generally invest smaller amounts than larger institutional investors. He also noted that individual investors were thought to be less knowledgeable, less disciplined, less skillful, and prone to behavioral and emotional decisions, saying that despite their lack of knowledge, the retail investment space was enormous with individuals. He added that knowing and understanding potential investors was very crucial when presenting the equity story, and consider having a fair balance of investor type, saying that investor relations plays a pivotal role in providing detail about the health of an organization to a wide range of interested parties. According to him, the information disseminated through IR, that's investor relations, not only projects the financial and operational strength of the organization, but also enables a two-way relationship between company and its stakeholders. Those are insights from Mr. Tolu Oluwole speaking on the investor relations. Going further, he said the increase in stakeholder interest from optimal investor relations will ultimately result to an increase in the market value of the organization as long as the company delivers on its operational performance, noting the company's day-to-day interface include institutional and retail shareholders, bondholders, credit and equity analysts, the exchange, and the financial media. The principal role is to manage interests from these audiences and ensure they are fully informed about the performance of the business, as well as identifying potential issues to address proactively. That's from Tolu Oluwole from the first FBN Holdings Investor Relations. That explains further why investor relations is very important and why every quoted company should take it seriously. Let's go on to the global markets just for developments there. And the Federal Reserve, the U.S. Central Bank, whatever it takes approach, as we all will be watching this week as they take their decision, could stave off economic calamity and has already kept interest rates near zero, as we've said over time, 0 to 0.25% points. It has helped to drive the U.S. stocks back to pre-pandemic record levels, while weakening the usual dynamic between safe haven U.S. Treasuries and riskier equities. Stocks and bonds moving in parallel is one of the distortions the Fed policymakers may ponder when they meet this week, although they are expected to let the emergency measures already implemented in the wake of the coronavirus outbreak work through the financial system. The recent rise in Treasury prices, which typically climb when investors seek safe harbors during uncertain times, appears at odds with the exuberance seen on Wall Street, where the S&P 500 last week came within 3.5% of its February all-time high. said before it was clear the spread of COVID-19 will wreak havoc around the world. The S&P 500 and the US 10-year Treasury notes typically move in opposite directions, such that when equities rise during periods of confidence and risk-taking, bond prices fall, pushing yields which move inversely to prices higher. Analysts have said the traditionally negative correlation between stocks and bonds reflects the extent to which bonds will effectively hedge against a stock sell-off, such as what happened during the global financial crisis in 2008. That relationship has broken down at times during the pandemic, for instance, since mid-June, and the US benchmark 10-year yields have fallen more than 20 basis points, while the S&P 500 has gained roughly. Well, the US and China trade tensions and the worsening diplomatic ties is going to give investors all the room to flight to safety. Yes, investors are running and looking for safe haven. That's the situation. The challenge between US and China agreeing in terms of trade is rattling investors, and they're fired up now in demand for the safe haven metal, while stock market sentiment is mixed ahead of corporate earnings. European stocks are expected to claw back some of their sharp losses last week Friday, with the Euro Stoxx 50 futures up by 0.2%. In Asia, stocks were mixed as a 10% rally in Taiwanese chip heavyweight TSMC cheered some other tech shares across the region, which helped prop up the broader market, with MSCI's ex-Japan Asia Pacific Index rising by 0.4%. TSMC's surge came after US rival Intel signaled it may give up making its own components after falling far behind schedule developing its newest technology. Chip-making machine makers may see reduced demand from Intel for now, but as the jump in TSMC shows, markets are not pessimistic about the semiconductor industry, said Yasuo Imanaka, chief analyst at Rakuten Securities. Elsewhere, there was less enthusiasm, with mainland Chinese shares giving up most of their early gains, with CSI 300 index last up 0.1% after steep losses last week Friday. Global shares had lost steam late last week after Washington ordered China's consulate in Houston to be closed, prompting Beijing to react in kind by closing the U.S. consulate in Chengdu. U.S. Secretary of State Mike Pompeo took fresh aim at China, saying Washington and its allies must use more creative and assertive ways to press the Chinese Communist Party to change its ways. Definitely, the U.S.-China relations is still one of those big factors for global trade and the market activity and economy, apart from COVID-19, and that is what we'll continue to watch and monitor in the course of the week. The second half of the year, a lot to watch out for in the market, and that is what we're here for, to give you insight on the financial and capital market as it relates to the economy in Nigeria, sub-region, Africa, and of course the world. And that will be all for the market review for today. Join us throughout the week for reports, analysis, and exclusive interviews on Nigerian capital markets. Also log on to our website www.proshareng.com to get our videos and also read our news reports and analysis. A special note to all our investors and the public. Please, this period, beware of online platforms that promise you 100 to 200% returns and are not registered. Please do not if they are not regulated or registered by the Securities and Exchange Commission, do not give in to their offers. Avoid their schemes and strategies, which is all to rip you off and render you financially bankrupt and financially sick. You don't want to, in this period of challenges, go through that phase. So please, make that wise effort. Make inquiries, ask questions, don't invest in stocks or don't invest in platforms that are not registered by the Securities and Exchange Commission. That will be all for this edition. Looking forward to an interesting conversation with you tomorrow, and we expect to see you by 10 a.m. Thank you for watching. Have a nice day, and always remember, you have to stay safe.